Hey guys, thank you for tuning into this video. I wanted to talk about max-funded IULs. That phrase is going around on social media, TikTok, everywhere. Max-funded IULs. I'm getting a lot of clients calling me, asking me for a max-funded IUL. And here's the thing about it. I don't recommend max-funded IULs for everybody. I don't recommend it. A lot of people are going to be like, "What? I've lost them right now." It's controversial what I'm saying. I know it, but I don't recommend it. I'm going to show you why. Um, I don't think that that's a one size fits all for everybody because it's not. A max funded IUL, maybe if you're in the, you know, top 10% or you've got a whole bunch of money already, maybe you could just throw out, do a max funded IUL. But a max funded IUL, let's talk about what that means. What that means is you're setting up an IUL account where you're paying your monthly premium. And yes, some of the money goes into the bucket that pays for the insurance. The other money goes into your cash value, which accumulates based on that market index, right? So you want this, a max funded IUL, that term, what that's referring to is the idea that you're paying as little as you can for insurance. You're getting the smallest insurance policy as you can to maximize the amount of premium going into your cash value. That's why it's called a max funded IUL. I'm going to show you right now from an illustration that I've run. I run these all the time. Many carriers, it's the same. I'm going to use one particular carrier here. But what happens is you'll see that this max funded policy is not the best for the client, and I'm going to show you. Okay, so first I'm going to show you the max funded illustration. Okay, so hold on, let me share my screen. And here we go. Okay, so you should be able to see my screen now. Um, this is a test client. Could be anybody I've worked for. In this case, the client's male, age 25, non-smoking in Michigan. All right. So they want this max funded, which would be an increasing death benefit. Um, they want to pay 300 a month. 25-year-old wants to pay $300 a month into their IUL account. Okay. I have minimized how much insurance they would get, how much life insurance. So this is most of the money's going to go into the cash value, which is the case even with um, a level policy. So most of the money is going into the cash value, and the over the time the death benefit will increase over the years. That's how this works. Okay, so after 1 year, he's 26. $300 a month times 12 months is 3,600. Okay. Now this last column on this illustration represents the closest to the market. Uh, the interest rate is closer to the market value. First of all, another thing I like to do that a lot of insurance agents don't do, I like to create illustrations where I've diversified the crediting allocations. I don't like to put 100% into the S&P or into whatever, nothing against the S&P. I just don't, I like to split it up so that like at least 50% is going here and 50% is going into the S&P. That's fine for me. The reason why is because if if I put all my eggs in one basket and that particular crediting segment, that allocation has a bad year, well, then I'm gonna fully have a bad year with it, or relatively bad year. You're still protected from market losses. So it's not, a complete bad year, but it's going to be the minimum, right? So if I put 50% in another crediting allocation, then now I'm getting the average of the two. So I'm almost guaranteed to never have the absolute minimum that the insurance company offers. In fact, you are guaranteed to have like I'm trying to think. I'm not going to put out a guarantee. I don't know every single insurance company. Um, but most of these all work the same. They typically, your IUL is always going to have a 0% floor, at least a minimum guarantee of a 0% floor, meaning that you will never go negative in your interest um, from market activity. All right. So that's the only guarantee I can tell you about an IUL. Right. Okay. So here we go. I like to split into two different, at least two, sometimes more crediting allocations. In this case, I did the uh, S&P was 50%. Okay. Came out to 6.03. Okay. Percent. Now, what that means is this illustration is going to assume that throughout the whole, it's just an illustration. The other thing I can guarantee is that your numbers will never be exactly like what's on this illustration. But what's happening is it's going to assume that the growth of the cash value is 6.03%. Okay. This is the maximum I can illustrate with these parameters. With a max funded IUL on somebody 25, paying $300 a month, this illustration comes out like so. So what this is saying, this account value is how much money's growing. It's actually in the account, the cash value. This is the death benefit. Let me move my death benefit. As I said earlier, it's going to keep increasing every year as you age gracefully. Okay. Surrender value. This column's important because this is the amount you have access to of your account value. So I have access in year 6, account value is $21,268, but I have access to up to $20,870. Okay, so about 90, a little over 90%. Eventually, in this one, when we get to year 16, I have access to 100% of my money from this point forward. Okay, so after 10 years, this client has put in 36,000. The account's at $40,647. Okay. You're ahead. You're not always going to be ahead after the first 10 years. Not always going to be ahead in terms of what you have access to either. Right. Okay. Um, but these are done long-term growth. Okay. You're thinking long-term growth. You're not doing this for 3 years and going to be some millionaire. Okay. This requires the magic of compound interest to work for you. After 20 years, this person has put in 72,000 and the cash value is at over 122,000. Okay. After 30 years, 108,000. He's put in 108,000. He's 55 years old and the cash value is over 277, almost 278,000. Okay. So I went to 65 and I decided at 65 he's going to retire. He's going to stop paying into the policy and he's going to take a yearly salary. Okay. So at 65, he's completed his lifetime contribution of $144,300 a month for 40 years. Okay. At this point, the cash value is over $500,000. Okay. This is can be considered a conservative interest rate. Okay. Um, because if I show you the market has typically performed better, but we're just looking at an average, right? So what's happening here is most people get to retirement age and they're going to live off of a yearly amount. They're not going to take all the retirement all at once. Okay, now this money is tax free. You're not going to have to, we take it out as a loan tax free. Okay, that's how we do it. You would never just, I don't know anybody that would take a withdrawal and choose to be taxed. But we would take this out as what we call a loan, and loans are untaxable in the United States, right? Whether you take a loan for a car, take a loan for whatever, the government can't take take tax out on a loan. That's why insurance companies call these loans, right? So here we go. I don't know anybody, well, most of the general population is going to say, okay, I want to, I'm going to take a yearly amount. I'm not going to take it all at once. Now you could take it all at once. You could take, money and put it into start a restaurant, pay, uh, buy equipment, whatever you need to do to start that restaurant, right? You could take as much as you have, and as long as I would never take 100%, but maybe, you take as much as you need, as long as you're paying your monthly premium, you're going to keep your insurance active. But I would never recommend taking out 100%, guys. I'm really just being somewhat hypothetical here. Okay. Most people are not going to take 100%. They're going to say, I'm going to take a salary and I'm going to live off that for the next, right to the end of my life, right? The average life expectancy in the US is between 77 and 78 years old, somewhere in there. So what I did was I imagined that our person here is, I did it to 90 years old because that's pretty safe for most people. And so what I did was I basically just annuitized his cash value over the following 25 years. And what he gets is he's taking out a salary of $52,764 tax free. Okay. He's taking this every year. And this, at this point in his life, he's probably paid off his house. He's probably not putting kids through college. Most of his major expenses are gone, right? So without a mortgage or, you 52,000 a year probably covers a lot of people. Okay. Um, so here we go. When you take this money every year for the next 25 years, what you can see is that basically from a lifetime contribution of $144,000, he's created a potential retirement income of over 1.3 million. Basically about 10, almost 10 times, a lot more times than he put in, right? 52,764. Okay. And that's really quite good, off of $144,000 lifetime contribution. You know, you almost 10x'd your your contribution. So let's just say it's the face amount initially was 100,000. I know it's 100,481. And then by the end of it, he's taking out a yearly salary of just under 53,000. That's the max funded policy. Okay. That's pretty good. Looks good, right? Okay. Now I'm going to show you what when I show my clients a max funded policy versus, I don't know what I call it, a non-max funded policy. When I run the same numbers, I'm going to show you. Okay. So same thing, puts in $300. A level policy, put it that way. We're doing option A, level policy. Okay. Put same person, test client, 25, male, non-smoker in Michigan, $300 a month. On a level policy, from day one, the initial amount of insurance is over $300,000. So it's 3 times as much as the max funded policy. And this is from day one. From day one. So now we're putting in this money, same type of thing. Notice after the first 10 years, oh, he's put in 36,000, but he only has access to 33,000. So in this case, he's flip-flopped. It may seem like he's upside down. But again, I told you these are long-term saving strategies. This is not the short get rich quick type of deal. Now, continues to keep paying for his policy. Same thing, $72,000 in after 20 years, $111,622. Okay, let's just skip to retirement age. Retirement age still, he stops at 65. Again, he's put in a total lifetime contribution of 144,000. But look at this. All of a sudden, he's getting $53,746. Isn't that higher than what the max funded policy was allowing? Let's see. Here's the max funded policy. 52,764 was the salary. Let's go back to my level illustration. 53,746. Getting more money per year. And not only that, but from day one, got 3 times as much insurance. Now imagine this client is married with a baby on the way. I would rather have more protection from day one than less. It just makes sense, right? Not only that, but this face amount represents if something were to happen to you between now and your retirement age. Say you were diagnosed with chronic illness, a critical illness, terminal illness. Um, you're in a nursing home. You're in some situation. Maybe your medical insurance won't take care of certain bills. All of a sudden, you can flip this death benefit into a living benefit, and you can use this money in life. And it doesn't matter if you were diagnosed with cancer and you've got, you know, 18 months to live, and you want to take that dream trip to Europe. You can do that. Okay. So this number here from day one is already 3 times as high as the max funded policy. Now, you probably want to, how is this happening? Okay, so I'm going to show you. The interest rate, notice before it was, what was it? 6.03%. Now it's 6.35%. The max funded policy was less. And this is often the case for many people because what happens is the insurance company will reward you for buying more insurance by giving you a higher cap. A lot of your crediting allocations, excuse me, have caps. So what I'm going to show you here is the cap on the S&P, for example, is 11.50 on this max funded policy. So when I use that as my crediting allocation, which I love the S&P 500. I tend to always use that, but it's the illustrated interest rate is now 6.03 because the cap is 11.5. If I say I'm going to get more insurance, once in this case, I just happen to know once I get over $150,000 of insurance, the cap on the S&P is now 12%. And what starts to happen over 40 years, over 20, 30, 40 years, that's going to make a difference, right? Because there's going to be years where that the market's going to hit the cap. And so therefore, your this level policy here is going to outperform the max funded policy. And the person that did this level policy is now getting 3 to 5 times more insurance from day one, and in retirement age is taking a higher income than they would have gotten on a max funded policy because of the effect on this interest rate. because they're rewarded for getting more insurance. A lot of insurance companies operate like that. So I know there's a lot of people advocating, or you're hearing that term, max funded policy, max funded IUL, max funded. You need to look at both. You need to look at both. You cannot take for granted that a max funded policy is in your best interest. You know, again, I think, at a certain amount, you're doing policy, you're putting in $500,000 into an IUL, or you're putting in $1 million. Well, a max funded policy at that point might be an automatic decision because your insurance is already so high that it probably support, and you probably have other money to take care of um, any band-aid type situations that need to be taken care of. So for the one percenters, okay, but for most of working class people, most average Joes, a max funded policy, it's not automatic. So please don't get stuck on that. I know there's a lot of agents, or just a lot of information on YouTube, social media, people talking about these max funded. I'm seeing these ads from these insurance gurus that are showing max funded policy, but that does not work for everybody. It's not in everybody's best interest. Okay. So look, I'd love to work with you. Give us a call. My number's on the website. Um, Hope this video helps you, and look forward to hearing from you. And thank you for watching this.